Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate, with host Glenn Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. with Glenn Sutherland. This week, my guest is Evan McLeish and Pavel Portellas. Hey, before we get going on this podcast, I wanted to let everybody know about the conference I'm holding again this year. So this will be the second annual Canadian Investing in the USA conference. This year we're going to be focusing on single family. Last year we focused on multifamily. So this year we're going to be talking about all the creative strategies to buy real estate with no or low money down in the United States, how to get your corporate structure set up, how to pick your market, set up your teams. We're going to go over all the basic stuff. We're going to be talking about the advanced stuff, the subject twos, the seller financing, all of the fun stuff as well. So if this is of interest to you, Doubletree Hilton, Toronto Airport in Mississauga or Toronto. It's on September 14th. I hope to meet you all there. Let's shake hands. Let's do some real estate. And there's going to be a ton of people. This is going to be a much bigger event than last year. So there'll be a ton of networking, talking to people who have already done it, picking their brains. So I think there's going to be a huge upside to this event. You can pick up your tickets at glensutherland.com/conference. And there are some advantages to getting in there early. We're going to include a free lunch for the early birds. And we're also going to have a cheaper ticket price. So anyway, jump over there, pick up your tickets. Back to the podcast. Evan or Pavel, if you guys want to start off by giving us a bit of an intro to yourself, or maybe we'll do one and then the other one.
Sounds good. Yeah, so I'm Evan McLeish. So I started out my real estate journey over a decade ago. I was buying single-family homes and putting rentals in the basement suites, fixing up the buildings, and refinancing. So kind of your typical BRRRR strategy. I was doing a lot of the general contracting on that, doing a lot of work myself. At the time, I was working at a pulp mill, so I was 4 on, 4 off. On my days off, I would be purchasing these single-family homes and doing the construction and kind of acquiring rentals at space. I was able to acquire enough that I could eventually leave my T4 income job and pursue real estate full time. And that's when I started purchasing multifamily properties across Canada. I purchased in Saskatchewan and New Brunswick and Nova Scotia. And then I live in BC, so Prince George, BC.
Entire country then.
That's right. So you gotta wear a little mask while you're doing it. But so was able to do that. We were able to purchase about 7 or 8 buildings, about over 100 units. At that point in time, I realized that the economies of scale in Canada can be difficult. A lot of these properties were 12 units and under. Every time I was looking at a 16 unit or above, just because the housing shortages in Canada, there was always a premium asked on the price, so it was very difficult to make the numbers work. And a lot of these properties, it was even more difficult to get them in kind of main cities like Toronto and things like that have a good economy to kind of back the rental. So they were always secondary or tertiary markets. So at that point, I started looking south into the U.S. and I was underwriting properties in Tennessee, the Carolinas, Florida, Ohio, and then Texas. And then so eventually, like most people that are looking at value add garden style properties, kind of ended up in Texas because it has a very good kind of mixture of just equity appreciation growth, but you can also get decent cash flow if you buy the properties right. And that's when I teamed up with Pavel here, and we started Midfield Investments. And so I can get a little more into Midfield Investments, but I'll let Pavel introduce himself first.
Yeah, thanks, Glenn, for the opportunity for being part of your podcast. My name is Pavel Portellas. I got involved in construction 2008, and that's how I kind of started getting my feet wet with the capitalism world. I come from a communist country. If you guys can suspect what a communist country is a system full of restriction and brainwash systems. So I had to kind of reborn when I first came here, and battled with a lot of obstacles and objections when I first came. So it wasn't an easy ride for me. Fortunate enough, my drive and my passion and my goals were too strong that I wasn't going to allow to let my current situation that I experienced defeat my purpose. And I did so. So I started learning several trades in construction. I began a company in 2014 called Safe Unlimited Masonry. That company got dissolved or got switched to a company called Maxcon on 2017 with a much stronger team. We started with 4 guys in 2017. We have right now, as we speak, between the fields and the operations, about 182. 2 months ago, we had about 160. Now we add a couple of guys more because we keep rising in demand and growing. So it's been a crazy ride for us. In 2017, I started doing a lot of single family homes. I started doing waterfront properties in the cottage area. And we would get those dilapidated cottages, turn them into nice high-end cottages, and implement the famous bird strategy. We refinance them and rent them out and repeat the cycle. And that's how I got involved with real estate. I loved it. What happened was it was a lot of, despite that I was dealing with a very restricted municipality rules that wouldn't allow us to grow, single family homes wasn't something that I saw too scalable. So I transitioned slightly to smaller multis. Mm-hmm. Some of them acquire in Florida, some of them acquire in Canada, but still the effort that I was putting in and the time that I was putting in, and it wasn't enough. I needed to grow to a bigger properties, and I couldn't find the scalability that I was looking for in Canada for many obvious reasons. So I started investing time in how to acquire larger assets in across the country, especially in the United States. So I met Evan almost, I think, over a year ago on one of the mastermind groups that I'm part of, and we started talking with each other, and we saw there was an incredible fit, and we complemented each other very well. We offset each other's skills pretty well because I am a one-of-a-kind person. Evan has a different personality, different skill set. So we kind of have a very good team, and we were adding when we were creating Midfield Investment, very expert into the team, so we can add a lot more value and more transparency and more security to the investors. So as Evan explained, now we are acquiring larger assets in Florida. Mainly we acquire two main strategies. We get value add properties and core plus properties. Yep. Again, a Canadian structure, Canadian investors, and we give the opportunity for those people that are accredited investors that they want to get the upside potential of being part of an owner of a large asset class, but they don't want to deal with the downside that comes with being a landlord. So we give these fellows the opportunity to partner with us and still enjoy the returns and the benefits that real estate offers. And here we are. We're trying to keep growing the business and keep exposing ourselves to the market, keep letting people know who we are and what we do. And I'm just happy that I'm able to share our journey so far.
One thing you said there right near the start was like just all the obstacles to overcome and the mindset to overcome, just like switching countries and everything. And like you skipped over so easily, but I think it's so difficult to actually do. I think a lot of people are like, oh yeah, it's just like you come to Canada and you see all this and you see the American opportunities, you see the Canadian opportunities, and then piece of cake. No, like I think that even for Canadians, seeing the opportunities that exist here and being able to take action in their own country, I think a lot of people don't take that step. They don't realize the opportunity around them. And I think a lot of people just glaze over how difficult that is to be able to do that, right? And it makes me think about myself. What am I even have blinders on? Because we all do. We all have blinders to something.
Yeah, I totally agree with you. I made it sound easy, but just because I know we have a limited time on this space, but it was actually very difficult. It wasn't easy at all. I think I always say in life, you don't get what you want, you get what you deserve. And the deserve aspect of it is a direct reflection of how you choose to spend your time and how big your dreams are. I think that's what it's all about. And opportunities are there for everybody. The sun comes out and shines to everybody, and we all enjoy the same environment. It's just some of us get ahead in life, and others just because we're willing to do things that others are not willing to do. And that is very simple. It's a matter of sacrifice. It's a matter of habit. It's a matter of having a purpose and a meaning in life, and having the ability to go or do whatever it takes to go from A to B. And that's kind of my mindset. And I'm just keep strengthening that mindset and reinforcing the positive ideas which had made me come to this level, and just trying to be 10 times better so I allow my course of actions and ideas elevate me to a higher level farther down the road.
Oh yeah, I totally get it. And even just switching countries, you get the momentum, you start changing and you start learning stuff, and you start. Anyway, we could go down a whole path of just talking about this. I almost should have had two podcasts, one with each of you, because there's like so many different topics that we could just talk about. But that honestly, it's powerful stuff, and I think a lot of people can learn from this. Honestly, even myself, just thinking about what you make these blinders up for yourself, and you make obstacles for yourself, and you make anyway. I'll go down this thing. Maybe I don't. Whoever wants to answer this, but so midfield, you guys are you're doing and buying some properties, or you're underwriting properties in, I believe, Florida right now. So like, let's just go into like what are you guys doing? Hello, everybody. Thanks for listening to the podcast. I just wanted to let you know that I've created a new coaching program. I believe the new coaching program has way more value than any of the programs that have even existed in the past. What we've done is pre-recorded all the lessons so that you can work through it at your own pace, which is pretty cool. And then we're going to meet up on a regular basis to answer the questions, do deal analysis, and actually spend our time together working on things instead of spending our time learning things. I think this will make a seamless transition to buying in the United States and will help you solve a lot of your problems. If this is of interest to you, go to glensutherland.com/coaching. I hope to help you guys invest in the United States, and I hope we provide as much value as possible. Back to the podcast.
Yeah, so yeah, we're kind of mainly looking at the Sunbelt states, so Florida and Texas are probably the two main states that we look at. So really, we look at two main strategies, and the first is our value add kind of opportunistic approach. So it's a little more hands-on, a little higher risk, but it also comes with its higher returns. So these are the properties that are, a little bit older, so 80s, 90s, 2000s vintage. They're more distressed properties. So we'll be going in and we'll be fixing up the suites. And a lot of times they have been mismanaged, so the expenses can be a little bit higher. And so we'll kind of get the expenses down. So increasing your income through renovations, and lowering your expenses through just management can raise your net operating income, which in turn raises the value of the building. And so that really can give us a more kind of hands-on approach to raising the value of these buildings, a more targeted approach. Our second strategy is core plus stable growth. So these are properties that are, maybe 10 years old, probably 5 years old and newer. And these are essentially just newer build properties that have been mismanaged, or, we're seeing a oversupply in the market right now, especially down in Texas. So sometimes, oversupply can mean that we can get a discount on these newer properties. So buying, and then also these core plus properties, we can get favorable financing on them, but more so than the older distressed properties when we purchase them. So the reason why we kind of approach it with this dual strategy approach is we can kind of weigh the opportunity cost between the two different strategies, because sometimes just because you can doesn't mean you should. I think a lot of times people look at, these older value add properties that are really highly distressed, And maybe you can buy it and make the returns work, but it could mean that you have to take on these massive renovations and bring extra capital to make these properties work. And during those renovations and during the time that you're raising all the capital to bring, and there's just more risk that can happen, right? Especially when you're taking on these heavy renovations, every wall that you open can be a surprise. So there's really just at the end of the day, if we're looking at a value add play that is going to take a lot of our time and take more capital, there can be more risk there. And say we'll be looking at maybe 17, 18, 19% returns for our investors on that play. And then there'll be another property like a core plus stable property that we can get like 16% returns. And this one's just you're going in and you're remanaging it, and maybe we can buy it at a discount. So we're just going to take maybe slightly less percentages on our returns for our investors, but the risk profile will go down significantly, and the probability of risk coming up just through heavy renovations will go down significantly. So I think, that's probably the biggest thing that I see people do is that, you punch in the numbers, you can do these heavy renovations and make numbers work, but it can take up a lot of your time. And so it means that you can't take, basically advantage of other opportunities that come up, or just higher risk comes up while you're doing the properties. So we kind of play in those two different strategies. And we kind of weigh them back and forth when we're looking at opportunities, just for opportunity costs and the time that we're going to allot it. So we don't have bottlenecks. And so we're not paying attention to one of our properties because it's just taking a bunch of our time and neglecting others. So it helps us really balance that kind of profile.
Yeah, it makes a lot of sense too. And I've even with the buildings we're looking at, it's the same thing. When you do those massive renovations, typically you're creating vacancy, which hurts your cash flow. It hurts, how you can even pay your investors, and your scheduling for how you even are going to do your payouts throughout the whole project. And I think it's changed a lot over the last year. So maybe even that's an interesting question. So how would you say your strategy has changed from 2 years ago to now? Maybe even just talking about financing, the different kind of value adds you're doing.
Yeah.
That path.
Well, I mean, the environment over the last 2 or 3 years is, I mean, it's almost unprecedented, what we've gone through over the last couple of years. When I started looking down in the States, that's when interest rates were super low. A lot of the COVID stimulus was hitting the market. Inflation was going up. Appreciation in the properties were going up. The value was going up, and it made it very competitive to kind of get into properties, and you had to take a lot of risk that the market was going to continue to going up to get into these properties. What's the main thing that has changed is there's been a lot of people that purchased in late 2021, early 2022 on they either purchased these value add properties with bridge loan debt. So as the interest rates were going up, when the Federal Reserve raised them over 5% over the year and a half there, their debt service on these loans went up significantly. And essentially, we're looking at a lot of properties right now where these people couldn't even play out their value add plan on these buildings. And so they're still, these properties haven't really been upgraded, and these operators are kind of in a really tough spot, and they're just looking to sell these properties at a discount. And then the other side on our core plus stable growth strategy is we're seeing a lot of developers that they had construction loans, and the interest rates went up during these construction loans as well, and basically the mortgages and the debt service on these development plays took away their returns. So they're also looking just to get out of it, break even, make a little bit of a profit for their investors. So it went from this, money's cheap, lots of competition in the market, you would have to overpay really and be really optimistic moving forward. Fortunately enough, we didn't get into too much of a snag like some people did, where they just overpaid, and we're very optimistic about the market. And then interest rates went down, and the brake pedal went on the economy, and now we're kind of sitting in almost the opposite of that, where money is pricey. We need to buy these properties at a significant discount. And there are a lot of operators and people selling their properties in a really tough position. So it's creating some amazing opportunities right now to look at, where a lot of times where you get your best pricing on acquisitions is the pain of the seller, and kind of the difficult situation that they're in. And right now, with value add kind of teams that purchase these older properties, and construction builders, developers, they're definitely in a tough spot.
So if for people who are listening to this and going, well, does it make sense to buy? Does it make sense to buy when the interest rates are high? Does it make sense to buy when there's blood in the market, and there's people having issues?
Mm-hmm. Yeah. I think it always makes sense to buy if you can buy it for the right price, and you can be conservative on your underwriting, and you can be realistic about the outcome of the property. I think where a lot of people get into trouble is they just overpay, and they have a lot of hope that the market will go up and the rents will go up, and they're not really paying too much attention to the economy and the fundamentals of just investing and in the real estate. So right now, the higher interest rates and all those individuals that purchase properties with a game plan that their interest rate was going to stay at like 2 to 4%, now they're paying like 8 to 10% on their bridge debt. That's a whole different, that's so much stress to add to a property. It puts them in a very tough predicament. So although money is more expensive, interest rates have gone up, that just means that you need to buy the property for cheaper to kind of make to make the game plan work. And there's a lot of distress in the current market and the sellers right now, that you can potentially buy these properties for that lower discount price. So in a year and a half, 2 years from now, you can really take advantage of once interest rates come down. Of course, again, you want to be conservative on your underwriting. You don't want to just assume that they're going to drop 5% as well. But the kind of stress that the expensive money is playing on a lot of these operators means that you can buy these properties at pretty historic discounts in the market. So as you play out your game plan in 2, 3, 4, 5 years, you can kind of take advantage of that lower equity kind of gain that you're purchasing right now.
Yeah, no, I'm seeing the same thing. And the sellers of the property understand that where the rates are. They understand where the cap rates are as well. And you can, in the past, at least I was seeing, whenever we were offering on buildings, they'd see a whole bunch of offers come in based on where the actual cap rate is, what the actual value of it was with the the net operating income divided by the cap rate, and that's where the offers were coming in. Whereas now there's an opportunity. There's an opportunity to pick these up for and I'm not even exaggerating, millions below the asking price.
Yeah.
And so there is and it's just a toss up. You're paying a little bit more money in your carrying cost or your financing, and sometimes you can mitigate that even with changing your leverage rates on the loans. It might mean doing a bigger raise instead of doing the higher leveraged debt, just to keep things safe for everybody. So what is it like? You're just talked about two different strategies right now. I'm just going to kind of bring us back a little bit, but which way are you finding that it's that you're actually finding the deals? Which strategy is actually sort of coming into your hitting your underwriting criteria right now?
Yeah, I think we're seeing a lot more value add opportunistic buildings right now to purchase. And that's just because, bridge debt in real time, the interest rates went up, and there's a lot of sellers that are kind of in a rough position. we're going to see some more core plus stable growth properties but it's going to be kind of a little slower over the next year and a half as these developers finish their projects and as these newer buildings hit the market. Definitely down in Texas right now, you're seeing kind of a record supply hit the market. And so just that kind of, just with a lot of buildings on the market trying to be sold, we're going to be able to buy those at a discount. But we're definitely seeing a little more value add plays right now that are advantage. What is kind of different in that aspect is, sometimes when these properties are being sold, so let's just take like a traditional value add play, like an 80s deal, garden style property that you need to go into and fix up the suites, add some amenities, and reorganize the expenses. A lot of these individuals bought with low interest rates, so they were able to get significantly high leverage. And that made it so they could purchase these properties for higher purchase prices, especially to stay competitive in the market. So what we're seeing right now is we're going to these properties, and let's just say their loan on these properties are 10 million. I'll be underwriting them at these new higher interest rate environments, and we're saying, well, we got to buy it for 7 million. Like, we can't even give you the loan amount on this property. And so that changes the dynamic of you're really trying to have more conversations with lenders, because that's essentially where a lot of these properties will go, is they'll go to foreclosure or the banks will get the keys, and then you're in negotiation with the lenders, and you're having conversations with property managers as well to get kind of that backdoor access to a lot of these deals. Because when the lenders get the keys, they call the property managers to say, like, hey, can you, help me out here? I don't want to own buildings. Can you come in and raise the income here, lower the expenses? And so maybe I can try and sell this and get my loan amount out. So it goes from the fact that these people bought for a really high purchase price and their loan is significantly high. And there are buildings out there that you can't even give them the loan amount to purchase these properties. You actually have to give them less. So you have to go into different avenues with lenders and property management to kind of get the access to these deals. So that's definitely what we're seeing pretty prevalent out on the market right now. And then again, like, we'll see the core plus stable growth strategy probably play out more over the next year and a half when more of the products hit the market.
And I'm just thinking about this, because we've been talking about a lot about making these numbers safe. So is there, like, in your underwriting or even just in your mental, like, this is a no-go sort of deal, if the property has like too many units that need to be renovated, is that a no-go? If there's a certain level of vacancy, is there a no-go? Is there certain spots that you're just trying to stay away from right now? I have more free content. So if you're interested, I created a PDF guide and a video to go along with the PDF guide to complement it. And what the guide is all about is the 5 most common mistakes that Canadians make when investing in the United States. So if you're interested in this free guide, go to CanadianInvestingInTheUSA.com/mistakes. And let's go back to the podcast. And it's free.
Yeah, I think, when you're looking at most properties, like, for the most part, what we're doing is we're going into these value add plays, looking to purchase them with fixed rate debt. And so a lot of these properties you can buy with fixed rate debt. If the property is big enough, you can get supplemental loans. So after you're done your value add plan, you can go to the bank and say, hey, here's the value I created, and they'll top up your loan, and you can kind of get your refinance through that avenue. So we're being a lot more conservative on these purchases, with just going in with fixed rate debt, buying them at the cheaper properties. But as far as underwriting goes, I think, where you really want to be conservative right now is your market appreciation growth. So when you're doing your underwriting, a lot of times, like, we'll say, okay, I'll put $10,000 into this unit and I'll get $100 premium. But on top of that, that's kind of your forced appreciation aspect to the underwriting. You'll also have your market appreciation growth. So do you think, just the general, do you think Houston will grow, 2% in rental income for the first year, second year? third year. So I think that's where, a lot of people probably got into trouble over these last couple of years is you kind of, especially like in Florida, you had to pencil in like 4 or 5% market rent growth just to pay the price that they were asking.
Right.
So a lot of the underwriting that we're doing right now, like we're assuming just 0% market rent growth in the first year. Because if you look over the past year and a half, like it's been negative in some markets. So you just want to be super conservative in that aspect, and then really bleeding out that market rent growth slowly over our 5-year hold period. We generally won't drop below 90% occupancy. Cash flow is king. Cash flow is everything. It'll kind of save you in a whole bunch of different scenarios. So if we can buy these distressed properties, and go with agency financing, Freddie Mac or Fannie Mae. Generally, they'll look for 90 for 90, so 90% occupancy for 90 days. So a lot of these properties will be looking for at least minimum 90% occupancy with, and they've been able to hold that kind of occupancy for a long time. And then of course, especially in the Sunbelt states, you want to be conservative on your insurance right now. Insurance has gone up significantly. So with anything in your underwriting, you really want to get minimum 3 quotes on everything with your lenders and your debt, with your insurance quotes, with your expenses on these buildings. You want to be having a lot of conversations and networking with a lot of people just to make sure that you're not just getting one person's opinion, you're getting numerous opinions. And you're comparing them all, and then looking at the competency of the person that's going to kind of bring that value to your projects.
That makes a lot of sense.
Yeah, Glenn, I also wanted to add to Evan's comment there. Just our strategy is not just about buying properties, but also about buying a building that is sustainable enough that allows us to grow our portfolio that generate consistent cash flow. As he mentioned, cash flow is king. So we typically don't time the market or that to me is gambling, buying a property, hoping it goes up. We actually perform proper underwriting and implementing proper due diligence to make sure it is a safe investment for the investors, and we minimize the risk that way. And I think that's where a lot of lack of education and information out there that inhibit people from making decisions. There's a lot of people with a lot of capital park on the worst place that you can park money, which is the bank. Worst case scenario, they're investing in paper assets that are performing poorly, which barely offers any tax advantage. And I think the lack of information is huge out there. So I think getting a little bit of education and understanding how this could be a very safe investment, it is a very good way to begin for these professionals. Yep. And they can better understand that, we're here to build a sustainable portfolio that is going to be cash flowing and is going to be safe in a way that we do our due diligence and our underwriting. And that's what makes us special about ourselves, because we don't pull the trigger on any opportunity. We only pull the trigger on opportunities that make sense. Because if the investors don't get paid, we don't get paid. That's the way we have to structure our distributions. And that is an incentive for them, that they have the peace of mind to understand that whether or not the property, like they need to understand that if the property don't perform, we don't get paid, because they have preferred shares, preferred equity that they have to get first before anybody else get paid. So it is in our best interest to make these properties perform. So we had to keep it up to that level as well. But just wanted to allocate the need for some of the education that these individuals may have, and that it just simply takes a conversation to us. If they can just simply book a call with us, just so we can walk them through the process and how, even though we're not financial advisors, we can easily tell them this is how your money could be performing on vehicle A, and that's how your money is performing in vehicle B. What is going to happen 5 years from now? Then we walk them through the process and we let them make a decision. Of course, they always have the right. Actually, we encourage them to seek for additional information in lawyers and attorneys, because you're not financial advisors. Yep. We can always explain what we know and what we have tested in the market so far.
Yeah, no, it makes a lot of sense. And it's about creating a win-win. And honestly, you need the investors to win first, right? And I like that approach. Evan or Pavel, if people were interested in midfield, how do they get a hold of you guys?
Yeah, so we have our midfield investment page on Facebook. We also have our Instagram page. We also have we're on LinkedIn individually and as midfield investment as well. And then we also have our website, investmidfield.com. And through the website, you can download our evergreen deck, which will explain kind of what we do and how we do it, and where we invest and what we invest in. And then you can also book a call with us through those avenues. And I'm sure maybe we'll put those in the show notes.
Sure,
and
send them over.
if you can have the links. And then yeah, we're online. We're pretty available. We have a lot of we're available on most social media platforms, and so you can learn more about us through those.
Appreciate it. Appreciate both of you guys coming on the show. This was it was great. Thank you.
Thanks, Glenn. Yeah, it's a great call.
That was a nice video. Bye.